Right. We were trying to think of a different term to use that didn't sound both academic and condescending at the same time.
Right. Exactly.
We failed.
Hi, Meg.
Good morning, Scott.
Welcome to another episode of Real Personal Finance. Today, we are going to chat about something that we were just kind of noodling on before, things that we've seen with some clients coming up, kind of asking about how we're building portfolios. And really what it comes down to is what's a philosophy, an investment philosophy for thinking about how to build a portfolio. So I think that's what we're going to start with today.
Right. And no client has ever come to me and asked me, what's your philosophy for building an investment portfolio?
No.
But it is evident in the questions that clients do ask and the conversations we do have that having a well-defined philosophy is essential to sort of maintaining healthy control of your investment decisions. Because, as you and I have both seen, with sort of the resurgence of the stock market, I mean, all like the big FANG or whatever they're called now that everyone's changed their initial letter,
yes,
and NVIDIA has been added in, with these stocks just hitting sky high values. That's really, I would say, distorting some clients' attitudes towards the investment decisions they're making. All of a sudden, it's like, no, I don't want to get rid of that stock because have you seen how much it has grown?
100%. And I think the key today is let's walk through a framework of how we think about building portfolios. And then let's also think through some of the things that are happening in our little human body, our being, our brain, that get these questions to come up because they're normal for us as humans. And they're almost always counterfactual to what's an optimal portfolio. So I think it's an interesting dichotomy that needs to happen between how should we think about building portfolios, and then what are some of the issues that come up along the way for us as humans that run into when we've built that portfolio, we want to go do things and make changes and have ideas.
Yeah, and I think there's a really strong analogy to sort of our modern eating habits, which I'm sure we're all aware of, the sort of hyperpalatability and universal availability of food. All of these modern aspects of the food landscape are at odds with how our brains instinctively think about food, because we're sort of instinctively trained to eat as much as we can when we can, which works really, really poorly in modern times. And there's a direct analog to how our brains sort of developed and how that is really poorly suited to the modern stock market.
Absolutely. Yeah, 100%. And there's actually these terms that are very academic that exist in our space. And the one that we've both seen from clients recently is this thing that we would call recency bias. And bias has such a negative connotation.
Right. We were trying to think of a different term to use that didn't sound both academic and condescending at the same time.
Right. Exactly.
We failed.
It doesn't exist. If you think of something, let us know. But what it really means, though, from a behavioral bias standpoint, which is really our brain, the millennia of evolution that have happened to make us survive, there are these triggers that happen for us. That these biases, and the way they would define a bias is literally a predictable error or influences that apply to everyone when they make these decisions, right? So the idea is not that it's just happening to you, it's that it's happening to us as human beings. And so we need to find ways to build systems that in a sense kind of protect us from our own biases when we're investing.
Right. And I think the only thing that distinguishes us as sort of investment professionals from everyone else, it's not that we don't have the bias. We absolutely have it just as strong as everyone else. It's just that we know about it. We've, become educated on it. We've named it. And therefore, we've built some structures and processes, as you were just mentioning, to help protect us and our clients against it. That's the only distinction between us and just regular folk.
100%. And what we'll actually see, what we actually do see when you actually go look at the data is if you go look at professional money managers who actively try to beat the stock market, they put these biases at work in their lives all the time. They don't mitigate them because of the way that we operate, which makes it almost inherently impossible to outperform markets, is one of the issues that they run into. So to your point, like even the most well-trained people, if you don't have systems in place to protect yourself from those things, you're going to fall prey to those things too.
Yeah. And as I had already mentioned, one of the ways that this recency bias in particular is showing up is this idea of all these big tech stocks, which are performing so well. I mean, just unbelievably well. And so people want to hold on to their tech stocks, which is in contrast to 2 years ago after, the big implosion in the tech industry, and like all the big tech stocks had lost, upwards of 80% of their value.
Right.
And 2 years ago, people were like, sure, I'll sell my RSUs. Who cares?
Yeah, but that points to a very inherent bias that we have as human beings, right? And it's basically, but it is, and how counterintuitive is that to anything else in life, right? Because what did you just say there? You just said, now that we're at all-time highs, I want to keep holding or buy more. But when it was at an all-time low, I wanted to sell it and definitely didn't want to buy more. So I literally wanted to do the opposite of, right?
Buy low, sell high.
Buy low, sell high. I wanted to buy high and sell low. And that's one of the points that we need to point out for all of us, because it's natural, right? In that moment to want to do that. But it's also tying into this idea of recency bias, which is the idea that what's happened in the recent past will continue to happen in the future. So if everything's going up and to the right, like my stock price has hit an all-time high, well, it's just going to keep going and hit more all-time highs.
Absolutely.
It can't not go down, right?
It can't.
Or the opposite, 2 years ago, when it's going down, 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 all it can do is go down to zero. Like it's going to fail miserably, right? So that's what it's normal for us as human beings to feel that. But that's not actually the best way to manage our money.
And the other thing that a lot of people are sort of seeing and getting sort of attached to is the US stock market in general, when you compare that to the stock market in the rest of the world. I mean, the US stock market is just trouncing the international stock market.
Right. And if you don't know that much about markets, because like maybe this isn't like you're not, maybe you hear about the S&P 500 or the Dow Jones Industrial Average or the NASDAQ on the news. Those are just different forms of US stock markets. The US stock market as a whole is about 3,400 companies and is worth about $50 trillion, right? And makes up about 61% of the global stock market. And then you have this thing called developed markets, and that's and emerging markets. Those are the two other main markets we have. And to Meg's point, the United States stock market has done better than those two markets in recent years, right? So the developed market are things like the UK and European nations and Japan and Australia. And that's, 22 countries, 6,500 companies, $21 trillion, about 27% of the world. And then emerging markets, that's like China, India, Brazil, Colombia, who tied Brazil yesterday. I'm now marking this for the Copa. My son watched it last night with me. They are about 24 countries, 10,000 stocks, and about, call it $10 trillion, about 12% of the world. So there's all these opportunities around the world. But to Meg's point, right now, the U.S. is doing well. So it's easy to think like the U.S. is doing well. So let's just invest in the U.S. because why would I invest in those other places when they're not doing well?
Doing as well. Yep.
Right. But here's the problem. Here's the problem. And this is a little nerdy. Okay. I'm just going to warn you ahead of time. There's like a big nerd alert coming. But when you invest in markets, there's this thing called the risk-free rate. And the risk-free rate is investing in like a United States Treasury bond or Treasury bill, because literally the government can literally just print more money. So if you get a 90-day T-bill right now, they're around 5% and something. You're going to get that 5% back, right? That's not going away. That in a sense is risk-free. You give them your money. They're going to give you your money back 90 days from now. You're not going to lose so long as you hold it for that period of time. In order for you to go invest in a market, a capital market, you need to get a rate of return that's higher than the risk-free rate. Otherwise, you wouldn't choose to do so.
Why would you do it? Yeah.
Wouldn't be rational, right? So when we look at markets like the US stock market, the S&P 500 on average has returned about 10% per year. Okay. And then the small companies in the United States have returned, let's just call it 12% per year. So by investing in smaller companies, now smaller companies are more risky. So I would expect a higher rate of return over time, right? But over shorter periods of years, those numbers don't always suss out, right? Sometimes the large companies will do way better than small companies and vice versa. But the point is that as you're investing like that, you're gonna see that what happens. Well, the point I'm trying to make is as the large cap stocks do really, really well, these tech companies are doing really, really well, and they're going up in price really, really high. It inherently makes it so their future return has to get smaller. Yeah. Compared to other things. Because if a lot of the returns already happened, it's very hard for it to keep going at such a high rate. It eventually has to come down. And we see it happen in capital markets again and again and again. What happens to most people with recency bias, not most people, but some people with recency bias, and this honestly happens with institutional money managers all the time. Yep. They see something's been doing really, really well, while something else did really, really poorly in the last 3 years. So they'll swap it out. They'll say, I want to invest more in the US and less in international. And then what do they see happen almost always, time and time again? The past does not predict the future. Because you've just had higher rates of return in the United States, it makes it harder for it to have higher rates of return in the future. The thing that hasn't had higher rates of return recently has more probability of having higher rates of return because it hasn't seen the return yet. So it's counterintuitive because it gets back to the same thing we started with your clients of, everything's gone down, I'll sell it now. Oh, everything's up really high, I want more of it. Right. And that's the recency bias at play.
Right. And all that investment nerdery really can be summed up in the investing bromide of buy low, sell high.
Right.
Buy tech company you've never heard of, sell NVIDIA. Buy international stocks, sell US stocks. It's just that this is extremely painful to do because it doesn't at all match up with sort of our instincts.
So one of the things that you can, now I think we're actually already at such an amount of time that I think we'll just splice this up into 2 episodes. But one of the things that you can do here is you can create for yourself some rules around how you invest. And we'll talk more about how we think about constructing a portfolio in the next episode. But one of the things that we'll teach you about, and we'll teach it in the next episode too, but there's this idea of a tolerance band. And what a tolerance band is it just says like, hey, I'm going to go invest in the US stock market and I'm just going to make up a number. I'm just going to say I'm going to invest 10%. Now, more than likely, I'm going to invest more than 10% because it's 60% of the world market, right? And we'll talk more about how to think about building a portfolio, but it's just for the example. Well, when we look at tolerance bands, especially for the stock market, a tolerance band of around 20% is a really good marker for when to buy and sell something. Okay. And so when I give a tolerance band of 20%, that means if I have a 10% position, I'm going to add 10% times 20% is 2%. So plus or minus 2% to my 10% band. So I'm going to say, hey, I'm allowing this position to grow to 12 or shrink to 8.
Shrink to 8.
Right. So within the portfolio, it's going to go up and down based on other markets and other positions I have. But if it crosses the 12% threshold, I'm going to sell it and bring it back to 10. Yeah. What did I just do there?
I sold high.
I sold high. And then with that 3%, what I'm going to do is I'm going to go look at what's low in my portfolio and I'm going to buy it. So I'm literally going to sell high and buy low. And then the opposite happens. Like during COVID, we did this with all of our clients. The portfolios were tanking on the stock market.
Ooh, very fast too.
Very, very fast. But bonds were relatively stable. Now, in that moment, of course, there was fear and panic and all these things. But when you have a system that is built on an investment philosophy, that's built on academic research, that actually has like a tried and true path to it, you can trust it. And so in that moment, we sold bonds and we bought stocks. Because stocks were underallocated in the portfolio. So what you do is you build a portfolio with tolerance bands that makes sense, and then you allow the tolerance bands to dictate when you make trades. And that removes the recency bias emotion from the trade.
Yeah. And I think the tolerance band is one example of probably a handful of just rules you make up ahead of time, not make up as in pulling out of thin air, but rules you create and write down for yourself ahead of time, so that when the markets or your investment portfolio get really exciting, you are not acting on emotion. You're actually looking back at those rules that you wrote down in calm times when you were talking with your investment advisor or your spouse or whoever, and you just execute to that. Those are the rules that, like Odysseus, who wanted to listen to the sirens without crashing into the rocks, had people lash him to the mast. These investment rules are the ropes that lash you to the mast of your investment ship so that you can listen to the stock market going up and going down and crashing and zooming and mooning without actually taking any action that is going to crash you upon sort of the shores of, I don't know where this metaphor is going at this point, but anyways.
Keep rolling. Yeah. to your point, though, I did explain what tolerance bands are. And the reason we use tolerance bands is because we know that when you look at the research of the optimal way, when you can afford to do so, the optimal way to make changes to portfolios is to allow portfolios to move within those bands and then make the changes at the moment it's needed. But another way you can do it is have your percentages set. And then every 4th of July or every Christmas or every Memorial Day or whatever day works for you, sit down and look at your allocation and say, do I need to sell anything and buy anything?
Right.
You can do the exact same thing based on time.
And what you're describing is what people might also recognize as the term rebalancing. Right. Just to throw that term out there. Now, for me, the sort of being a word nerd, this is an example of hysteresis. Which is also in play with your thermostat. Like, let's say you want your house to be at 65. Well, and it's cold outside. So you don't want your heater to turn on when it gets to 65.1, or excuse me, 64.9. Your heater is going to wait until it gets down to like 63.
Yeah.
And then push it back up to maybe 65, maybe a little bit over. But there's this band of inactivity where you're just seeing what happens. And only when it crosses that threshold. Otherwise, your heater would be constantly turning on to off, on, off, on, off, on, off. And in the investment world, that would be constantly poking at your portfolio.
Yeah. And, in a portfolio, a retirement portfolio, that may not matter too much because, transaction costs are down and there's no tax consequences. But in a taxable account, it matters a lot because, you keep, every time you do a sale, there's going to be some tax consequence. And so I forget who specifically said it, but I've always remembered it. And they said that portfolios are like a bar of soap. The more you handle them, the less you have. And that's really the whole point. But it's kind of, and again, it's kind of antithetical to the way that we think as human beings, that when there's these moments of either excitement or moments of sorrow, we feel this need for action. Like we need to do something. And it's like, no. We only need to do something when the system that we've designed says it's time to do something.
Right. And this is why you create not just an investment philosophy, but investment rules that you write down, because we do, as humans, have this bias towards activity. But as we were both discussing before, another one of our favorite sayings about investing, I mean, there are a ton of them, but I think this one was from Jack Bogle. And his saying was like, look, don't just do something, stand there, which is, sort of a riff on the opposite saying. But that is, in fact, an essential behavior. The ability to do nothing while stuff happens in your investment portfolio and in the markets. So
Absolutely.
don't just do something, stand there.
So don't just do something, stand there. Yeah.
Yeah.
All right, cool. Well, that's fun. Well, let's tell you what, the next episode we'll geek out on how to think about actually constructing a portfolio.
Sounds good.
Thanks for your time, Meg.
You're welcome. Ciao.
Bye.